With inflation a hot topic at the moment and the stock market getting the wobbles after the US Consumer Price Index rose 0.8% in April, I've been doing a lot of research on inflation and considering the potential implications it could have on portfolios. And there are some big hitters out there, like Warren Buffett, that are calling inflation. And he came out in his latest Berkshire Hathaway shareholder meeting and he said this.
Very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. And it's being accepted. People have money in their pocket and they pay the higher prices.
And I don't doubt what the buff man is saying, because we're seeing it here in Australia. I mean, if you've looked at the housing industry lately, the cost of building and the cost of materials to build are just skyrocketing at the moment. I mean, look at this graph of the price of timber over the last 12 months. But the real question is this inflation or reflation? So put another way, is this the beginning of a sustained increase in prices above the long-term trend? Or is this simply a recovery of prices off of a low base? To help answer this question, I came across a really good article by Jamieson Cook Bonds entitled "You Say Inflation, I Say Reflation." And I thought it was worth sharing some of the ideas in this article with you guys. Historically, inflation has generally been driven by either a significant increase in energy prices or a significant increase in wages. It's also prevalent during times of war, where there's a lot of demand for military output. Reflation, on the other hand, often comes off the back of a deflationary period or a recession. It's a monetary or fiscal policy engineered response, which is designed to increase output, stimulate spending, and stop deflation. So in the current market, which one do you think is more likely? Well, we're coming off the back of the COVID-19 pandemic, which saw rolling lockdowns worldwide, oil prices turn negative, and unemployment spike. This is all highly deflationary for prices during a period where inflation has been relatively low for the last 10 years. The response to this from governments and central banks worldwide has been an unprecedented level of monetary and fiscal policy designed to increase employment and stimulate growth. And largely, it appears to be working. We are seeing the impacts of the stimulus combined with the world slowly reopening and the vaccine being rolled out. At the moment, people's demands for goods and services are high, and they have the money in their pocket to spend on it. But all this demand is coming off a very low base, a time when a lot of businesses out there were actually contracting. And all of a sudden, there's all this new demand for goods and services being pushed through. And so the supply line to be able to deliver those goods and services probably isn't able to keep up with the demand at the moment. So in the short term, if you want your goods and services now, then you have to be prepared to pay for it. But what we're not seeing is we're not seeing a huge jump in wages. Unemployment levels are still not quite back to where they were pre-COVID, and there's no significant spike in energy prices. So given these factors, it smells a lot more like reflation to me. And should you be worried about reflation? Well, no, because reflation generally indicates the first phase of recovery after a period of contraction. So while I think it is wise to make some tweaks to your portfolio to allow for reflation in the short term, and also the potential that it actually is inflation and it will be sustained increases in prices, it's important to make those small tweaks to your portfolio. But don't get too caught up in the inflation headlines that the media likes to throw around. But that's it for me today, guys. Thanks a lot for watching this video. If you did like this one, please give it a thumbs up and I will see you guys in the next one.